Welcome back to Turning Hard Times into Good Time. I am your host, Jay Taylor, and I'm really glad to have with me once again Michael Oliver, the most frequent guest, I must say, of all the guests that I have. I like to have Michael on for these 10, 12-minute stints to come on and give us an update on where he sees the markets heading. And so thanks for joining me again, Michael.
Good to be back.
Always good to have you, and I want to tell my listeners again, in case they don't already know and haven't jotted this down, it's OliverMSA.com. Oliver, M as in Mary, S as in Sam, A as in Albert.com, to keep up with what Michael is doing, and hopefully some of you will subscribe to his letter because I think it is very much worth it. I read it every day. It comes, well, whenever it comes. It doesn't come necessarily every day, but it's a very frequent missive that Michael sends your way, and it's always timely. So, Michael, you know, early last year, and as I recall, I don't remember exactly the dates, but you demonstrated that stocks and bonds, which had been in multiple-year bull markets, were starting to look topsy, and a couple of the markets like precious metals and commodities might be putting in a bottom or coming close to doing so. And, you know, and then you talked about these markets in terms of a tectonic shift. In other words, it wasn't going to be just something minor, but something very major was starting to shift and take place, and you felt that, you know, within maybe the next 6 months to a year or whatever, we might start to see some major turns. And just yesterday, you put out a chart showing that gold and gold shares as well as U.S. Treasuries were really the only markets so far in 2016 that have done very well, and everything else was pretty much in the losing territory. And stocks and bonds, and you know, except for Treasuries, everything was losing. And then really, this was sort of a zinger on February 3rd. You put out a missive to your subscribers titled "Gold at the Gates." And you were looking for a weekly close then, I believe, around 1141, somewhere in that range, and a monthly close of around 1159 or so. Well, we're ready. We're much higher than that now. I guess what you're saying is we have to close out above that 1159, and you know, we're quite a bit above that now. But certainly we've closed the week out above that 1141. So do you think that have you seen enough to say categorically that we've turned the corner, do you think? Do you think it's a pretty safe bet that we put in a close for gold and we're headed for something much higher?
I revised that monthly closing thing. The cluster of numbers that I had using various time scales of trend measurement from 50-week average oscillator, 3-quarter average, 3-year, 36-month. I used those 4 long-term oscillators.
Uh-huh.
I'm looking to cross the averages itself, but the structures of this oscillator define trend structures. They've all been blown out. Period. Mm-hmm. Exclamation point. It's over. You've seen the bottom. Gold's up. Gold's a bull. Period. I suggest that if you want to have a position in gold, it should be on now.
Okay.
You can nitpick about a $20 pullback or whatever, but basically, the gold has turned, and I think the gold miners are the better place to be, percent-wise.
All right. Well, I remember talking to you several months back. Gold was looking a little more hopeful, and you were suggesting a layered approach. You know, I think depending on when you get over certain levels to add to that position. What you're saying now, you're all in?
I'm all in. In other words, those numbers that were layered, 6 months ago or so, where there was quite a bit of distance between one indicator and another, all of a sudden they came to a narrow focus where one would break. The highest one I had was 1169. The lowest one I had was 1141.80. Well, that's what you're talking, a 1-2% zone of tripwires. And I've tripped through them all. We're now comfortably in the upper 1190s, trade there for 1200. I think it's broken out, period.
Okay.
I suspect that gold could have something very sharp and rapid, assuming this breakout's valid, and I think it's valid for every reason I can come up with. Another positive for gold is that it turned versus the S&P. Mm-hmm. One thing for a market to rally, it's another thing for its spread relationship, its relative performance trend relationship to change. And in the case of gold versus the S&P, I broke out of a 3.5-year wide base of relative performance action that says now gold has won the arm wrestling match, and now for the foreseeable future, I'm thinking a couple years anyway, gold will beat the S&P. And so the fact that occurred simultaneous with the gold price net trend turning up reinforces the validity, I think, of a bull gold argument. Now, simultaneous with that, we have a downtrend in the S&P, which occurred as soon as we opened the year. We broke massive annual momentum supports on the S&P as MSA defines those supports. Price action, we hardly even look at price action. We use price to create momentum oscillators. The momentum oscillator trends and the structures on those oscillators are what we look at. And as far as the S&P is concerned, as soon as it opened the year, it was dead. Done. It's a bear market. And I don't mean a correction. I mean a likelihood that this lasts until 2017 at least. The ultimate depth is beyond my ability to suggest. My first legged low, and no bear market goes from A to Z. They go A, and then have a rally, and then they go down again, and you might have 2 or 3 rallies before they finally get to where they're going. But I'm suspecting the first low could occur this month in the mid-1600s.
Wow.
For the S&P. Now, simultaneous with that, I think a gold upsurge could reach into the mid-1300s.
Wow.
And a lot of that, with my experience and the way these oscillators look, it wouldn't surprise me if a lot of that occurs very rapidly. In other words, you creep along for months fighting your way through the trenches, and then all of a sudden when you break free, whoosh. Yeah. And if you're not already there, you miss it.
Yeah. So maybe not too wise to try to trade it then. You don't want to try to get cute and pick the bottoms. You better commit some money now. Yeah,
I think that the long-term commitment, the long-term view is that if you own stocks, normal stocks, not the gold stocks, but and I would exempt also some commodity stocks from that. You should be out, and you should find other things if you want. If you don't want to be short, find other things to be long, and there are things to be long, and I think that would be gold and the arena around gold.
And gold shares, of course. You said probably gold shares. Silver. What about silver now, Michael? How's
silver,
that?
I think, will be gold as well. Silver, I think, will percent-wise prove to do better than gold in the next bull trend, which I think is just emerging now.
Yeah, it usually does. I know silver usually outperforms gold on the upside and underperforms on the downside. But Michael, to your credit, back on December 11th, you sent out a missive to your subscribers, headed up with the title, "A Chart to Nail to Your Trading Room Wall." You saw something there then already. That's 3 weeks or so before this definitive turn to most people in the beginning of this year. Although, of course, there's still always people that are hanging in there thinking that we're still in a great bull market in stocks. But nonetheless, what did you see in December 11th that really suggested that, hey, you guys, nail this chart to your wall, you're going to see...
I forgot. You'll have to remind me, what was the chart on that page?
Yeah, you showed an S&P chart. I don't have it in front of me now. But you had several...
200-week momentum, was that it?
Yeah, that's what it was.
Yeah, okay, it was a point.
There were several levels there and you gave dates and levels. If we pierce through those price levels, for example, I think in December 18th, you said 1941 on the S&P. I'm looking here January 8th, if we got through 1952. And those are some of the numbers.
We got a whoosh effect,
Yeah, we
got the whoosh effect. But I don't think the whoosh effect we got after breaking those numbers has really satisfied this move yet. I think there's a lot of people thinking, this is satisfied now. We're bottoming here in the low 1800s.
Yeah.
I strongly suspect on the underside of these lows, we'll have an update today, by the way. I think a nice calming day today will help placate the fears and all that. And then if you take out the lows later this week, the lows at 1812 that we made recently, that's when you could open up Pandora's box. And quite often these events, these cleansing final days of a major leg, whether it's up or down, occur within 3 to 5 day clusters. So it wouldn't shock me that once you take out the recent lows, that basically you're wherever you're going to go in about 3 to 5 days.
Yeah.
I think that could be in the mid-1600s.
That's going to be very frightening. I mean, if we're looking at 1860 now, as I look at the S&P 500, and you're talking about mid-1600s, that's going to be breathtaking. That's going to scare the bejeebers out of a lot of people, I would guess. And
then they'll come back again. You know how they are. As soon as you bottom there and then turn up and stay off that low for about 3 months, they'll think it's a new bull market again. They don't do their history. You go back and look at 2008, it happened a couple times where you made a low, rallied for a month or two, would not come back and take out the low for 4 or 5 months even. So plenty of time for people to rejuvenate their hope and optimism and all that stuff. And then you roll over and get them with another leg. And I kind of expect that process again.
All right.
Shutdowns, fake rallies, months spent wasting time, roll over, take out that low, and the new leg begins. It stretches out till 2017.
Michael, with about 2 minutes left, what about the commodities and the dollar? Might we get some relief? Commodities, do you think commodities in general, every market's so much different. I think you've indicated in the past you expect that oil will be what you call a Judas goat. That would be the last thing to turn up in the commodity complex, I believe, is what you were suggesting. But do we see some topping out in the dollar here and possible some help for the commodities?
I just sent out a report today. The dollar bulls are still around. They still talk the argument. They weren't there when they should have been, which is high 77s and 80 area on the dollar index. Whereas my report was quite bullish then. But it got to our target of 100 last year, and since then it's done nothing. It's gone into a range. Some people think that's a congestion range for higher levels. I see enough evidence that suggests you could be topping. We're now down under 96 today. You close out, I'm talking dollar index now, okay, which is an amalgam of the yen, the euro, and then some other currencies. If you close the month at 95.50, which is just barely below today's low, in my opinion, the dollar is going down into the high 80s. And believe me, even if it finds support there, that is enough of a move. And you get an opposite move out of the euro and the yen, which are quite strong right now, by the way, technically speaking. That will upset many apple carts and also help commodities. It will help the commodities base, bottom, and turn. Again, my emphasis, though, is on the gold. Another market I'm watching is corn. Oil will be the laggard, and I think it is serving the function of a Judas goat. It's leading the lambs to slaughter. And once it's finished, I think the oil will probably make its bottom, coincident with the S&P making its first major low.
Okay, it's first low, and then oil turns up, and then the equities continue lower again for another wave or two, huh?
Right. I think the relative performance, for instance, of the energy stocks, which have been vastly weaker than the S&P for a couple of years, will then suddenly, at that next low, become stronger than the S&P.
A vast virus database has been updated.
Yeah, it would lead the stocks will lead the commodity up, you think?
I think that the commodities, no. I think the oil and the oil sector stocks will bounce far stronger than will the S&P after it makes its first low. And then a divergence will occur where they may not go back to their low again, whereas the S&P is likely to go back to and through its low.
All right.
In other words, the marriage starts to break up at that point.
All right. Well, it's going to be fascinating to watch, and we'll look forward to having you back again many times, Michael, to discuss these markets. Always fascinating, always important for all of our listeners, I'm sure, who are investors. So thank you very much for being with us again, and we'll look to do it again next week or sometime very soon.